let's just quickly look at a few things that could be done when a company is facing financial difficulty. Now, this is not a list that you should memorize. This is just to give you some ideas of what are the possible strategies. So a company that is in serious financial difficulty could merge with another company. It could be favorable for the other company that takes over this company, since it will be acquired at a discount or cheaper price. They could also issue a rights issue. The problem with the rights issue is you have to look at the share price, because if the company is in financial difficulty, the share price would have dropped. And if the public already knows about this, and then any rights issue will bring in less cash for the company. They could issue convertible preference shares, because that way they don't have to worry about gearing. And remember, when you borrow, so there's only basically three options. There's debt, there's equity, so the equity is the rights issue, and preference shares is somewhere in between, but the preference shares won't influence the debt-equity ratio, and preference shares are not something where you'll have covenants or all those restrictions from the lenders. You still need to find someone that will buy the preference shares or subscribe or buy the preference shares. But you could also then make the preference shares convertible into ordinary shares if for instance, a dividend is missed, etc., to make it more favorable. Then also something that they could do is suspend dividends. So they could say, well, since we are experiencing cash flow problems, we're not going to pay dividends. The problem with that is, so always think of what is the issue. Why would they not do it? So the problems with suspending dividends is, what about the signal that it sends? Because if the company has been paying dividends for 20 years and suddenly it stops paying a dividend, it's going to send out a very strong signal that the company is facing problems, and that could trigger a sell-off, and then the share price drops. They can't issue a rights issue anymore because the share price is too low, etc. So you can see the relationship between the different elements. Then obviously one of the first things that they would do is negotiate with creditors. So that's quite important. And this also ties into refinancing. So they could, some of the existing loans, they could refinance, so go to a third party and an addition of someone else, or to the same lender, and say they want to borrow basically new money at new terms to repay the old debt. And this new terms might be more lenient. They could renegotiate the debt covenants, the restrictions, or it could be at a different interest rate, or there could be some period for which they don't have to pay interest. But at least if you negotiate with creditors before the problem is too serious, they might be more willing to help you instead of staying quiet until you cannot make a payment. Then they could also sell off non-core assets. This is also one of the things that you might consider fairly early on. If there's any assets that you're not using, any assets that's not productive, you could sell it and at least get some cash in to keep operating the company. And remember, what is the most important things? Pay your employees, pay the taxman, and pay your interest and capital repayments on any debt. So you might want to sell off non-core assets, or if there's a productive asset, you could sell the asset, get the proceeds, the cash, and then lease the asset from the new owner. So that's also a type of finance that you could make use of. And then the last resort, obviously, is liquidation. And just before liquidation, you could file for business rescue, which might end up in liquidation anyways. So we'll look at a business rescue a little bit later on. But these are just some ideas of what can be done and what you can use as recommendations for a company that is in financial distress. Again, don't memorize this. Try to think of when would you use any of these and what are the possible pitfalls of using